Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are going to check in here today as we start the week, on a week where we don't have that much macroeconomic event risk, with a look at where we are in the global business cycle, because one bit of economic event risk that is going to give us a bit more information on what all is going on out here is the monthly set of flash PMI numbers. These are coming to us primarily from S&P Global. And as those of you that have watched Macro Money know, this is something that is very near and dear to my heart. It's an indicator that I watch very closely as a kind of barometer on where we are on the global business cycle, on global growth, that is much more timely than what we might see from GDP numbers. First of all, these numbers are monthly. Second of all, they are, by their very nature, forward-looking. Whereas what we are talking about when we look at GDP is oftentimes lagged, it's quarterly, it comes out well after the economic conditions that the numbers describe have evolved into something else. And so we are going to get in these PMI numbers a very helpful look on what exactly is going on and how this might fuel really the range of markets. And so what we're going to do first here is look at what's expected. Then we're going to look at why it's important and how it fits into what's occurring around financial markets generally, and then talk about how it might move markets as these numbers cross the wires. So let's first begin with a bit of stage setting. This is what we have coming at us over the next 2 days. And what we're looking at here is going to be, first and foremost, focused where we have expected numbers, because that gives us a little bit of a baseline. As you can see, we don't have expected numbers for Australia and Japan. We do have them for the Eurozone, the UK, and the US. And so we're going to focus there. Of course, it would make sense to focus there anyway, because these are what I would call end demand economies. These are where the consumption comes from. Whereas, let's say Australia and to some extent Japan are more so depending on that external demand from the subsequent three, much more export-oriented in both cases. So if we wanted to get a sense for how consumers are doing, and of course consumption is the largest component of overall GDP growth in developed economies especially, but really for most economies, then we have a good window on what's going on if we look at the Eurozone, the UK, and the US. And the main takeaway here, if you look at those arrows, is that we're looking at a sea of red. There is a little bit of an improvement expected in Eurozone manufacturing sector activity. There's a little bit of an improvement in the UK. Consider that in both cases, we are below 50. In the logic of PMIs, 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. These are what are called diffusion indexes. And so what we're seeing here for the green arrows, Eurozone manufacturing, UK manufacturing sector, is that while both see an uptick, they remain below 50, and so they remain in contraction territory. So what this means is they're just going to be expected to contract at a slower rate. Everywhere else, services, which is of course by far larger than manufacturing for all of these economies, and thereby the composite, since services is so much larger, it is a sea of red. It is slowdown. And so what we are going to look at here is what that might mean. So consider first why this is important. In looking at these economies, these five economies, what we're looking at is 49% of global GDP just by themselves. And of course, if we consider how much they then power in terms of growth elsewhere, so consider, for example, how much of the growth in Mexico and Canada, and for that matter, China, is powered by U.S. demand, how much growth in Central Europe, say, is powered by Eurozone demand, we can see that these economies actually matter much more than their apparent share. So while the Eurozone itself, let's say, accounts for 15% of global GDP, how much of the rest of world bit on this chart depends on the Eurozone would suggest that that number is actually much bigger in practice. Considering how much China depends on the U.S. and that it's the world's second largest economy and a commanding piece of that rest of world section there, that of course counts that much more in that direction. So we're looking at the growth cycle here over the next several days of what is overwhelmingly the drivers of global demand and global growth. And as we look at them one by one, what you'll notice is something of a pattern. So here's the Eurozone first. What you see here is, as we said, we're expecting a little bit of a pickup in manufacturing, up to 46, but still very much below 50. Whereas services and the composite with it are seen dipping lower. This would be the first meaningful downturn, as a matter of fact, in quite some months for both. What we see since the last ECB policy announcement, and indeed over the past week, which essentially captures the majority of this month, is that policy expectations aren't really on the move. So the markets seem fairly well priced for what are baseline expectations of the business cycle, which means that however these numbers come out, if they surprise in a meaningful direction one way or another, there is a degree of complacency to get shaken loose here. These markets have not really moved in terms of their growth expectations, because, of course, from them follow yields. And so we should see in monetary policy expectations the trajectory of what investors are thinking about growth. We can see here there is very close clustering over the entire month, where the curve is now, where it's been since the ECB last gave us a policy update, and where it's been in the past week. They're so wedged together as to think the markets haven't really speculated on the direction of Eurozone growth for nearly a month. Looking at the UK, very similar situation. A bit of a lift for manufacturing, but as we said, still in contraction territory. Bit of a dip on services rather, and the composite. And here too, clustering. We see a little bit more of an upshift, a little bit steeper of a curve following the 6-month mark here for the UK. Of course, we're going to have UK CPI this week. We'll see if that actually survives. But you can see near term, still a ton of clustering, nothing really moving a whole lot here. And not a whole lot of speculation, which is, again, setting us up if this data veers off expectations for some degree of significant repricing. In the US, we're expecting to see basically flatlined manufacturing, so just a little bit lower to 50. That's not a tremendous sort of adjustment, but if you look at what the overall numbers look like, you can see U.S. manufacturing at 50.2 in April and expected to go to 50 flat in May. In other words, we are going from one kind of standstill to one that's a little bit more firm, but no meaningful changes there. And as we saw with the Eurozone and the UK, a bit of a downtick on both services and composite. And here too, tons of clustering in the curve. So you can see here the current one versus the one since the last FOMC announcement at the beginning of the month versus a week ago, again, covering the vast majority of May. No real speculation on U.S. growth. No real movement here. The market seemingly fairly priced for what's going on. So again, we've set up a situation where we're going to get a timely view on the business cycle after nearly a month of the markets ignoring this story for the most part. Now, it of course makes sense to some extent why they are ignoring it. We have a host of things to digest here. Certainly the aftermath of the banking crisis that we saw in March that was then kind of digested in April. We of course since had some bank failures, some major policy adjustments. It took quite some time for things to really settle. That seemed to shift gears to a focus on what's going to happen with the U.S. debt ceiling debacle. I've argued before, of course, that this notion that the U.S. is going to default can't even be speculated on. It's so ludicrous because if one defaults, that means one can't pay. And in the case of the U.S., that's not even a question. Of course, the U.S. can pay. The question is, will the U.S. choose not to pay because of a legislative quirk, essentially? And at this point, the markets are sort of actively starting to shift to a sense that we will get some kind of a deal. But since you can't really price into financial markets where the U.S. Treasury is the risk-free asset and the dollar is the undisputed medium of commercial exchange, the default of the United States, because of course that would mean that the risk-free asset is not just not risk-free, but close to worthless, and the dollar isn't a medium of exchange, it's close to worthless. Well, then do you even still have financial markets as we know them today? Ostensibly not. It would be sort of like pricing in Armageddon or an alien invasion. It's not really something one could price into markets while still expecting those markets to function. So what markets ostensibly have been doing is instead saying, well, some degree of deal is going to get done sooner or later. The question is how much fiscal headwind, how much fiscal tightening comes from a deal. If it gets done on time, somebody probably has to negotiate away a degree of the spending they intended. Somebody probably has to negotiate away some amount of tax hikes. And so we probably get a little bit of a fiscal headwind if a deal is done. If it's not done on time, then we probably get more of a fiscal drag because then perhaps the Treasury has to actually hold back some spending until it is done. And that probably is more of a fiscal headwind. And so the markets have seemingly reserved judgment on the global business cycle until we get to the other side of this. The U.S., of course, as we just saw, a quarter of global GDP and much more if you consider the dependencies. So we are in a situation where the markets seemingly have taken May, having spent April thinking about how much of the banking crisis is contagious and how much of it will continue to be a systemic risk, to then spending May thinking about when is this fiscal headwind in the United States going to get taken off the board, at least in the sense that it is quantified, and markets can start to price in exactly what is on offer. With that in mind, as the sense that we're getting closer to a deal seems to start to take shape, focusing on where the business cycle is against this backdrop becomes increasingly important, because then whatever resolution we do have will be compared against where the business cycle is already, to give us a sense of, well, if the business cycle is already turning, maybe a deal doesn't mean that the Fed has room to keep rates higher for longer, say, or maybe it does. Now, in so much as we're looking at then the business cycle in the context of this news, and we might get the news of a deal any day here, as June 1st, the cutoff gets closer, we are looking at ostensibly a market that's primed for some degree of speculation, having sat on its hands on just this subject since the beginning of May. And this is where looking at the macro cycle, which we've looked at before in kind of broad strokes, really becomes instructive, I think. So consider first, when economic data begins to turn, and of course we're focused on the UK, the US, and the Eurozone here, so we're looking at developed economy indices rather than global. That seems to be a telling way here, especially since they were the source of the most aggressive stimulus and therefore the most aggressive inflation and therefore the most aggressive tightening in the wake of COVID. And so they've really defined the cycle here. Consider that the economic data stopped aggressively surprising on the upside and topped in July of 2020. If we look at the Citi G10 economic surprise index, and we see that rapid recovery from COVID depths as that stimulus is poured onto the economy, we then see that there is a very significant 11-month lag, 10-month lag, excuse me, between the place where that data starts to turn and when PMI numbers catch it. Now, when we look at PMI numbers, they're called purchasing manager indexes because it is purchasing managers, so the people that are in charge of looking forward at major corporations and making sure that they have what they need to conduct business 6 months forward, 9 months forward, a year forward. Those things are, to some extent, as much as possible, anticipated, and that inventories are lined up, that the intermediate goods needed are contracted for, that essentially the company is able to do what it does in the coming quarters. And so a degree of demand anticipation, a degree of forward-looking lens is implied here. So when we look at purchasing managers' sentiment, we are, as I alluded to earlier, inherently looking at something that has a forward-looking component. So we can see that the data starts to turn a full 11 months before these forward-looking folks actually catch it. And we can see here as well that course, it's not always 11 months. These things are not so perfect. So you can see the bottoms here. Let's say the bottom in the index on September 2021 seems to roughly correspond to the bottom in developed market composite PMI on August of 2022, which is a little bit longer, not 10, but 11 months. If we look at where the peak then in the surprise index on April 2022 lines up with, it appears to perhaps line up with about a 12-month lag to what we saw last month. Because indeed, if we look at these PMI numbers that we just saw the expectations for right here, you can see all of the composite numbers look like they're pointing lower. So if we just guesstimate a bit where that overall index might go by discounting it by the same amount on average as its main component parts, it looks like we're looking for a bit of a turn. Not only that, but we can see most recently, the surprise index is again pointing lower and is at this point below zero. So it seems to be that if these lags hold and if the general direction here is sustained, then we are roughly speaking on time for a downshift. The downshift in that forward-looking sentiment, as we can see, precedes an actual turn in global volumes. So we can see the top in the PMI is, as we just saw, May of 2021. The actual downturn begins around March of 2022, right on time for the Fed to start raising rates. We then see that actual inflation is even more lagged. So once we get the growth downturn, only in October of last year does global inflation actually turn a corner, and that economic weakness starts to feed into what's going on to bring the price levels around the world and the growth rate there downward, which is, of course, the object of the game for central banks, to slow growth such that inflation comes back in. So as we look at this entire situation, then, if what we're looking at here is a downturn, then that should foreshadow further weakness in growth, which, with some lagging, will give us lower inflation. But because that lower inflation is so lagged, perhaps then we have both slowing growth and central banks that are prepared to hold rates a bit higher for a bit longer. And so how this defaults for the markets will be very interesting. How these numbers come out and ultimately shape what the markets are thinking about as we get the debt ceiling risk off the table and the markets say, okay, we can quantify the fiscal headwind. Now, what's going on in the larger economy against which this fiscal headwind will be applied? If we get a relatively disappointing set of numbers this go around, if in fact we are looking at something that's underperforming relative to expectations as we look at this data, and if in fact we are right on time or close to on time for a turn, as I say, going in the lag was 10 months, the next turn it was 11. If we get a turn here, it'll be a 12-month lag. These things should not be expected to be exactly perfect. After all, we're looking at the global economy, and that takes in a multitude of variables. And so a month here, a month there really isn't an unusual kind of inaccuracy in watching these cycles. But as we look at it, it seems to be that if we were to get a downside surprise, it would be some time before that downside surprise would show up in larger growth. It would be some time before it showed up in CPI. So we might have a situation where policymakers focused on inflation hold longer, and we start to really flirt with over-tightening and recession risk. Well, as it happens, Bloomberg has helpfully compiled the collective wisdom of market-watching economists and given us a median on the probability for a recession in these main economies within about a year. And that's what we're looking at here. Note that we've seen some meaningful improvements in the situation as it's been assessed in the Eurozone and the UK. So the likelihood of a recession in the UK still better than even at 58%, but it's fallen quite considerably. In the Eurozone, we're now less than even at 40. In Australia, we've been rising on this score, but still relatively meager at 35. In Japan, things have been relatively steady at 30. So we're looking still at a situation where the probability of recession is highest in the US at 65. And of course, that makes sense. The most aggressive tightening we've seen has been in the US. Not surprising, of course, because the most aggressive stimulus was in the US as well. So there is the most excess to squeeze out. There is also the most tightening to do it. So the markets seem to be positioned for that outcome. And to the extent that this data confirms it, we can, of course, make some assumptions. So if there is a recession in the US, because it's so commanding, as we've just seen in this breakdown here, we can consider that that probably has significant knock-on effects elsewhere. And if we were to actually see it, then the numbers elsewhere would start to rise in terms of the likelihood of a recession to then follow. We might then see a response tilted in the weak direction from risk, a positive response from bonds, a positive response from the sort of safety currency universe. That against, of course, the more cyclical kinds. So you might see something like the yen, the dollar, the euro, the pound do a bit better as relative to something like the Australian dollar, the Canadian dollar. Having said that, there is, as we look at all of this and various adjustments filter through the system, if, of course, there is particularly disappointing Eurozone data, those policy expectations might get ratcheted down more. That would hurt the euro. Similar for the pound if there's something outsized there. Australia and Japan, as we've talked about, low sorts of probabilities here, but both are very cyclically sensitive. The yen tends to rise when yields fall and vice versa, so very sensitive to overall risk on and off dynamics. Australia, the Aussie dollar, very sensitive to risk on, risk off dynamics because it is a commodity exporter and so is cyclically anchored. So we have a situation here where they would probably move regardless of their own recession chances. It's really how worried are we that this is the state of affairs, and if in fact we do get a U.S. recession. And the upshot, as we've mentioned many times before, seems to be that when the U.S. underperforms, when the situation economically in the U.S. is particularly weak as relative to its peers, its commanding nature means that that is bad news for overall sentiment. which tends to lead to cashing out. And the cashing out tends to benefit the US dollar. And so you can see here, this is, of course, that dollar smile framework that we keep coming back to. In situations where the US is growing significantly weaker than its G7 peers, the dollar tends to strengthen because that liquidation tends to benefit the world's most liquid currency. When you look at the flip side, that's much more a story of what we saw last year, which is higher rates make the dollar more attractive on a yield basis. But of course, everything we've seen so far this year has been looking like a move from right to left along this curve. And so it is with this in mind that we are going to be watching this economic data and really gauging how markets respond to it. Because ostensibly, once this debt ceiling situation is lifted, it is these dynamics that will once again be dominant as the drivers of price action really across the spectrum of global financial markets. And that is Macro Money for today. Thank you very much for joining me. I am here Monday through Thursday, right after overtime, which is a show that I do with our friend Chris Vecchio, head of Futures and Forex here at Tasty Live. We cover the day's events and try to make sense of what's going on. I'm also on with Chris for Futures Power Hour on Fridays, and on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, you can catch me opining on Twitter at Ilya Spivak. Thanks once again for joining. See you tomorrow. Godspeed.